Hey everybody, happy Friday to you. We're on the eve of the weekend, and let's finish up the week in style here. Today, we're going to kind of follow up on last week's session. Last week, if you weren't here, we talked about butterfly spreads, and we talked about some of the pros and cons of butterflies, especially in relationship to iron condors. Today, I want to switch it up a little bit and maybe fix some of the problems, some of the challenges we had with butterflies last week. We'll see if we can address some of those this week. So we're going to do that. I'm joined by James Boyd in the chat, helping me out. Appreciate James. If you have questions, feel free to type those into the chat. You can follow either of us on X at Brentmore CS, at James Boyd CS for additional content, financial related content throughout the week. So make sure you check that out. And I'm glad for each of you joining me. Some familiar names in the chat and some less familiar names in the chat too. That's great. And if you're watching on a recording, that's great too. Let's just talk about a couple things before we get too far into this though. Just reminder for everyone, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only. It's not individualized recommendation or personalized investment advice. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Paper money software application is provided for educational purposes only. And paper money does not assign short options early. And that's a factor because we're going to be dealing with some short options this week. All investing involves risk, including potential loss of principal. Let's see, past performance isn't a guarantee of future results, and probability analysis results are theoretical in nature, not guaranteed, and not to reflect any degree of certainty of an event occurring. Let's head on over to the Thinkorswim platform. Let's just pull up and see. The markets kind of did a big flip today. They started off pretty low, pretty down, but they've had a nice little recovery. We're actually in the black right now, in the positive. So there you go on that. And last week we talked about butterfly spreads, just plain old vanilla butterfly spreads. And if you're interested in that, I'm just going to put the playlist to this webcast, which is this Condors, Calendars, and Butterflies webcast, into the chat. You can check that out. If you're don't have access to the chat, i.e., you're watching on a recording, that's great. Just look at the channel, look at the Trader Talks channel. You'll see the different webcasts there. You can click on the playlist for the different webcasts. But last week we talked about iron condors versus butterflies, kind of, and butterflies in particular. The focus was on those. And one of the things we identified on those trades was that they tend to be lower probability trades. And that's a huge problem if you don't want a lower probability trade, right? And that's one reason why a lot of traders don't love butterflies, to be honest, because of that. Well, I want to show you how to possibly kind of turn those into not such a low probability trade this week. Okay, so we're going to talk about that. Now, when we talk about butterflies, just as a quick refresher, you guys know this, and let me just pull up a stock. I'll pull up, doesn't matter what stock, Amgen. Okay, here's Amgen. So if I did a butterfly spread on Amgen, so here's Amgen, stock shot way up. It's more of a neutral trade, so maybe you wouldn't, because typically butterfly spreads are more neutral trades. But you sell two contracts, I'm just going to put a -2, or we can do some multiple of these at a strike that you think the stock's going to be at. So if you think the stock's going to be around 240 or something, we'd probably sell two contracts around the 240 contract strike. And then you're going to buy one at a kind of maybe the range you think it may fit in, and buy one at the range that you think it's going to fit in. In other words, we think it's going to be between here and here. Those may be the levels we choose to buy, and the two contracts in the middle. So there's, all told, 4 contracts two bought at separate strike prices and two sold at the same strike price in the middle. One way to think of these, if you're doing calls, is this is just a long call vertical and a short call vertical, just kind of squished together so that the short strike is the same. Okay, or a long put vertical and a short put vertical squished together so the short put is the same. But this is a non-directional, just a standard plain old vanilla butterfly is a non-directional trade. It's positive theta. Okay, that's an attractive thing about it. People like theta often. And it's a negative vega trade. And we said, well, that kind of sounds a lot like iron condors, and we explored that last week. But those are kind of some of the basics of a plain butterfly spread. That's how you do that. But let's say, let's tweak it just a little bit this week. And so to tweak it, what I'm going to do is I'm going to look at a stock. I'm not going to look at Amgen. I'm going to look at AMD. Now, we're most of the way through earnings season, and earnings are just kind of a variable that some traders elect to deal with and some traders elect not to deal with. And in this week, we're not going to elect to deal with them. And it's easier. 3 weeks ago, it was tough to find examples that didn't have earnings coming up in the next week or so. Well, now it's a lot easier. A lot of these stocks, well, we just had earnings. We're likely not going to have earnings again. Positive theta trade. Let's start off with a plain butterfly, but then we're going to tweak a little bit. And it's a negative vega trade. Right? So ideally, we want that implied volatility, which you can see right here. This is an average implied volatility, to continue down. Now, at some point, this will probably reverse course before the next earnings. Typically, before earnings, as earnings approaches, implied volatilities go up. But right now, I'm going to ride that trend here on this of implied volatility declining. And what I'm going to do is I'm going to say, hey, look, this is not necessarily a neutral trade. I'm going to say it's maybe a little bit neutral-ish to bullish here. Why do I say that? Well, bullish. What's the bullish case on this? Bullish case is, hey, it's been going up for the most part. We're above that 50-day moving average. We're kind of right at the 20-day, which was heading up. So it's kind of going like lately we have a lower high on that, but we have higher lows. And I'd say in general, we've been going up. So I'm going to say kind of bullish maybe. So one approach you could take is you could say, well, look, what I'm going to do is I'm just going to do a butterfly spread and hope it goes neutral. Or what we can do is we can skew a butterfly. We can unbalance the butterfly. We can do what's called a broken wing butterfly. Okay? Broken wing butterfly. And that is, we can change the strikes so they're not equidistant. Typically on a traditional butterfly, if you're selling, say, I'll just kind of make the numbers even here, the 250 contracts, sell two of those maybe, okay? And maybe we say, well, I'm going to buy a 260 contract and buy a 240 contract. See the nice even spacing there? $10 difference between this one and this one, and $10 difference between this one and this one. That's a normal butterfly. If we tweak one of the sides, but not the other side, then what we end up with is a broken winged or skewed butterfly or unbalanced butterfly. They're all synonymous, basically. So let's do this. Let's go to the trade tab, and let's just kind of start here with a traditional butterfly. And then what we're going to do is we're going to play around with it a little bit on the Analyze tab, because that's what the Analyze tab is great for. Looking at the risk profile, then you can see what the trade looks like. But I want you to see the difference here. So I'm going to start, and I'm going to go out, often we'll say, well, maybe between 20 and 40 days or something like that on a butterfly. Let me go here. I'm going to go to December 12th on this. Okay, go out about a month, 28 days here. And I'm going to go with stock's just a little bit below the 250, but that's the closest one we got here. So I'm going to go to the 250. I'm going to sell that. And I'm actually going to do, actually, let me do this. Okay, there's two ways you can do it. Let me delete this. One, if you want, you can just start and go change spread to butterfly here and do it that way. And then you can go, oh, 250 and just, kind of enter it that way. Or what you can do is you can go to that 250. You can sell that. I'm going to hold down my control key. I'm going to click that. And I'm going to do two of those. And then I'm going to go and we'll do the 260. I'm going to buy one of these. I'm going to hold down the control key. And I'm going to do the 240. Hold down the control key. And there we go. Okay. So what does this look like? Let's analyze this trade. Analyze trade. So this is what it looks like. This is what a butterfly spread looks like. This is what we looked at last week. Let me just make sure. Let me set my slices to break even, and we'll quickly see, I think, one of the challenges. One of the challenges is a very low probability trade. Okay, that's one of the challenges here on this. And so what I can do is I can, let's see if we can address that a little bit though. See if we can address that a little bit. So instead of, and I'm going to try and make it bullish at the same time. So what I'm going to do is I'm just going to kind of stretch it out a little bit and say, instead of the 240, 250, 260, what if we make this 235? See what happens. Ooh, do you see what just happened? Let me just uncheck that and see what happens to this trade. Now it's not that nice kind of symmetrical thing, but notice what happens. Now when I look at this on the high side, because we said we were going to try and skew this a little bit more bullish. On the high side, where's my risk? Well, this zero line, it's a little hard to see maybe. This is the break-even line. And you can see it's actually running a little bit below where my risk profile is. So at expiration, it doesn't matter how high we can go. I can scroll over on this page. This is going to stay just like this. In other words, we've taken out the upside risk on this trade. Okay, we've taken out the upside risk on that. Now, there's no free lunches, right? We also have increased. This is going to be a greater risk there. We're going to risk more if it goes to the goes down on us. Let me go back here. Let me set my slices again, break even, and notice what happened to my break even points. Okay. Here's my break even points. There's only one now. Okay, because in this case, it's in good shape. Now, let's do another thing. Let's look at this. If we go from, this was at 240, this was our standard. Max gain, about $888 or so, okay? Max loss, about 108. Doesn't matter whether it went up or down, about 108. Let's do this again. Now, max gain, instead of 888, max gain is still, it's actually a little higher on this. Max gain has gone up. But in terms of max loss on this side, there's no max loss on this side. I mean, this is great. We're making money here on this side. On this side, though, now our max loss is going to be greater, about $413 there, about $413. So there we go. That is, so I'm adding more risk if it goes bearish. I'm not bearish though. I'm bullish on this. If you're bearish on this, you would not do this trade. For our purposes, and I'm not giving my personal opinion here on bullish or bearish, I'm just saying the technical trade that we're demonstrating here is a bullish trade bouncing kind of off our low here today. We actually had a nice little bounce today on that. Now, one of the nice things about this Analyze tab is you can tweak it further. And you can say, well, look, if we did 235, 250, 260, remember our risk was about 413 on that. What if we skewed it a little further? What if instead of that, we made it 230? Tweak them, play with them. Now what's happened? Now I have even a little bit more gain here on this. And if the stock goes up, I'm actually making a substantial amount. That's $265 if the stock goes up. Now, this is not a long call. If you're just out gangbuster bullish on this trade, okay, if you're super bullish on this trade, then this may not be the trade for you. This is skewing more, this is neutral bullish. Okay, I'm going to say that neutral bullish, neutral bullish. I don't know. It's not a super bullish trade, but it is bullish, and we are making a fair amount of a reasonable return if it goes up on that. So here's my point. My point is, this is going to do a couple things. One, we're going to totally change the probabilities, okay? We've turned it from a low probability trade to a high probability trade. We've turned it from a neutral trade to a neutral to more bullish trade. We've also added more risk on the trade, of course, right? I mean, if we weren't adding more risk, then this would be the trade everybody would always do or something like that. So that's what we got there, okay? So let me go and just let's place. No, so which one do you like? It's not a pro or it's not a right or wrong. It's which profile you want. But let's pull this trade up. 230, 250, 260, and here was the original trade, and so I tweaked it right here. 230. Now, how are we going to manage these trades? Okay. Well, let's talk about it. Number one, we are doing this trade out, about a month or so. Usually when we get under about the 10-day mark, we're going to get out. I'm like a broken record on that, folks. I talk about this in a lot of these trades because we want to reduce the gamma risk. We want to reduce the risk of early assignment. We have short contracts here. And remember, short contracts can be assigned early. Secondly, so in addition to the short assignment risk, it can go from good to bad very quickly as we get very close to expiration. So we're going to get out with about 10 days to go. In terms of looking for max gains, when we look at this, we're probably not going to achieve our max gain. Remember, this is just kind of a pinpoint. The odds of hitting this $1,250 max gain or something are pretty slim. So if we can get about half that, if we can get to about $600, we're probably going to look to exit this trade. Next, what if it goes south on us? Yeah, because we have a substantial risk on the downside there. And so if it goes down on us, we're going to look to get out. And so what I'm going to say is this. I'm assuming we're bouncing from here. If I'm wrong, and I very well may be wrong, if we go and break this, what I'm going to call a support level, today's low, I'm going to look to get out. Now that level is about 235 maybe, something like that. I'm going to give it a little wiggle room and say if we go below 230, I'm going to get out of that trade. So let's place this trade. And what I'm going to do is I'm just going to make this a first trigger sequential order. And I'm going to right click and create an opposite order, one to get me out. Okay. So everything I'm selling up front, the 250, I'm buying to get out. Everything I'm buying up front, I'm selling to get out. This is going to get me out. I'm going to make this a market order. I'm going to make this good till canceled. And I'm going to click on the gear. The gear brings up a window in a different monitor here. So let me pull this over so you can see it. And what we're going to say is we said if AMD marks less than or equal to $230, we're going to get out of this trade. Okay, save that, and then we can confirm and send if we want. Before we do that, let's read this over and make sure it makes sense. And secondly, let me just address, Mary said, when you have this many combinations of options in out rolling, does it seem to manage bid-ask spread becomes more challenging? Bid-ask spread management can be more challenging, absolutely. So let's talk about that in just one sec. Let's just kind of review this here before I send it. I'm buying a butterfly, okay? And then I'm selling the same butterfly, okay? I'm getting out of it if AMD marks at or below $230. Max profit, we're unlikely to hit that, so we're going to get out if it goes down. If we get half of that, maybe we'll look to get out. Max loss 748. Hopefully, we're not going to achieve that. That's another reason why we're getting out early. We're going to get out at 10 days or so, 10 days, a week or so before expiration, so that we're not going to, this becomes much less likely that we're going to achieve that. Now, before I send this, let me go back and I want to look at this trade one more sec. Let me just edit this because Mary brings up a good point. And that is bid-ask spread. So let me address that. I did a December weekly contract here. These tend to have not as good bid-ask spreads as the monthly contracts, the ones that don't say weekly right next to it. Down here, you can see this, it doesn't say weekly next to it. If the stock I'm looking at has less liquid options on it, I'm probably going to look, even though maybe I would rather be 28 days till expiration, I would probably go to the 35 days to go to expiration because the spreads are going to be tighter on those probably. I mean, I guess I can't guarantee it, but that's usually how it works. Okay. So you need to double check them up front. So let's see what we got here. Here's my spread right now on this, okay? For this contract. It's about 20 cents or so, 20, 30 cents. Well, in a $20 option, 20, 30 cents is not terrible. That's the key. Now I can look over here and don't just look at the money contract, look at contracts out here, because sometimes what you'll see, oh, there's quite a bit of trading right at these at the money contracts. But once you start to drift out a little ways, the liquidity goes way down. Now you can look at open interest if you want, but you can also just kind of look at the bid-ask spread here on these. And if they start to get really bad once you go out a couple contracts, then you probably still want to avoid it, even if the contracts you're looking at look good, because you know what's going to happen to your stock? It's probably going to move. And the contract that you're looking at that's at the money will likely be in the money or out the money before too long here. So that is important. So that's the first thing, is just kind of double check. Well, that's the most important thing, is double check the liquidity up front here for bid-ask spreads. It's probably more essential that you have a tight bid-ask spread. I mean, I always want you to have a tight bid-ask spread, but it's, if anything, more essential to have a tight bid-ask spread when you have these multi-leg option strategies there. So double check that up front. I think that's what I could say for our management on this trade here. It looks pretty decent here from our purposes here. There. Now, one clue is when you're looking at this and you look down here and you see like a massive difference on this. And it may not show up when you're doing single options, but when you do these, I got a bunch of legs here on this, you're going to see the differences here are going to be very wide. on Thinkorswim, on a spread trade, it's going to default to the mid price. You're probably not going to get filled at the mid price. Okay. It's just, you want to be filled at the mid price. I'd rather not pay more, but I'm probably not going to be filled at the mid price. So I'm going to move it up from that just a little bit. I'm going to confirm and send. I'm going to go and put this in my butterflies camp there. Put that in. There we go. So, and we got a fill on that. Okay. So let's look at other potential examples here. When you're looking at these, you can do calls or puts. Essentially, those are going to look pretty much the same if you choose the same strike prices. Usually what we try to do, is we try to keep the short contracts out of the money, okay, if we can, when we're starting that trade. But you never know. If the stock moves, they're probably going to eventually be in the money. It's unlikely you're going to get assigned on short contracts right away. Okay? If you're doing these out a month or 3 weeks to go till expiration, even if the short contracts end up being in the money a little bit, early assignment is unlikely, but I can't guarantee it's not going to happen. Okay? It can happen. As you get closer to expiration, the odds go up there. Now, in the chat, I saw Chris, I think. Chris mentioned an iron butterfly. Okay, so look, we can tweak this if we want here and look at different variations on this. In fact, let's do that on the next, one we're looking at, and we can kind of compare one to the other on that, okay? So let's do this. Let me pull up ExxonMobil. And again, I'm going to consider this to be a little bit more bullish on the trade here. So I'm going to say about 120 we're at 119 right now, so that's probably going to be our closest strike. And let's go here, ExxonMobil, and let's say we're looking at this. Again, we have pretty tight bid-ask spread, a pretty tight bid-ask spread on these. As I mentioned before, though, if they're starting to get more suspect, like we got 6 cents difference here on this, well, that's not bad, right? 10 cents here on this, not bad. 11 cents on a $2 option, that's not bad. If it is more problematic, check these contracts out. And if that's problematic, don't do the trade, right? You don't have to do the trade. You can't say, hey, I'm going to try and force a butterfly and do the butterfly or any other multi-leg contract if it's just not set up for that. In terms of bid-ask spread. But in this case, I can do the same expiration date. I can tweak the expiration date, doesn't matter. We said 120. I'm going to look to sell the 120. And I'm going to say, look, I want to go down to at least a 115 range. So I'm going to buy the 115. Oh, now look, this is a little bit of a bigger spread down here at that 115. Let's see if it looks any better here if we go to the 35 days to go to expiration. Yeah, you see, that's a little bit better. That's a little bit of a tighter spread there on that. So let's do this again. I'm going to sell the 120. I'm going to do 2 of those. I'm going to go to the 115, which has a much tighter spread than on the different expiration. I'm going to buy that. I'm going to make this kind of equidistant to start us out. This is how I normally do skew it. You don't have to, but I usually start out and then I just kind of skew it, except I just messed that up. I held down the wrong key. We're going to do look, we're selling this. We're buying, hold down my control key, this. We're buying the 125, that. Okay, so, well, let's analyze it. Take a look, okay? That's what we're doing. Now, we had a question, because we're going to compare some things. What if instead of doing this trade, we did, let me go to add simulated trades, okay? And instead of this trade, we did kind of an iron condor, but let's put our strikes together on the iron condor, okay? So I'm going to sell the 120 is what we're doing. Call. I'm going to sell the 120 put. And I'm going to go out and I'm going to buy a 115 put. And I'm going to buy a 125 put. Let's compare. Let me go to risk profile. Let me uncheck this. And I have a lot of trades here, okay? So this is to Chris's question in the chat. You see the little difference here. Instead of a long call vertical and a long put vertical, here we have a short call vertical and a short put vertical, which you're going, that's an iron condor. Well, sort of, we've squished the strike prices together so that the middle strike is the same on both. Now look, if I uncheck this and check this, let's just kind of look as it stands. I'm going to skew this eventually, but I think this brings up a good point here that we should look at. What do we have with these strikes in terms of max gain? Well, max gain, I've got 366, max loss, 125. 366, 125. Let's double check. Let's compare. Compare and contrast. 366, 125. Here we have max gain, 335, 345, 150. About the same, right? They're about the same. Let's compare probabilities on this. Let me just go back here real quick and just double check my date. December 20th, set slices to break even. About a 20, we'll round that to 29% on that. And what's the butterfly going to be? Just did I double check? Yeah, that was close enough, I think. We said 29% set slices, break even, about roughly the same. Okay, so hey, here we go. There isn't much difference between the two trades here. And so what I would suggest you do is you just compare them, okay? You just compare them, and the perfect place to compare them is right on the risk profile graph. And then you can look at those subtle differences there on those and see what you got. Now, here's what I'm going to do. I'm going to stick with the butterfly here for a sec, but we're going to tweak it because we said we want to be a little bit bullish on it. And notice, max gain right now, about 355, max loss, about 133. If we switch this and we make it a little bit more bullish. Now, if I'm going to make it more bullish, which side am I going to stretch out? Which side do I expand there in this case? If you're more bullish, you increase the width on the lower side. So instead of 115, I'm going to go down to 110. Now notice, and by the way, just vice versa, if I'm more bearish, I'm going to expand the other side. Then I'm going to expand the side. You expand the side that you don't want it to go to. And if you think about it, it kind of makes sense probably, because if you expand that side, there's more of a difference between the strikes, and therefore there's more potential risk, because the risk comes in the difference between your long and your short there. Okay. Do we actually have, this one we still maintain, we're still going to have 2 break-evens on this, the way I did it. Now, we can tweak this further if we want there and see, well, maybe I change the strikes and see if we can get this so it's profitable here on this. But right now, yeah, on the high side, if it goes against us, we're still losing $48. Not the end of the world. It's not a huge loss, but technically we still have 2 break-even points on this. Okay, and we could reset those if we wanted to. Set slices, break even. There you go. So this still is skewing it bullish though. But to our prior point, what we can do is we can then tweak it. We can look and see, well, maybe we tweak it a little bit more here. We just kind of shrink this in. And now the max loss we have is $12 on the high side there. So probably not, and I'm not factoring in, by the way, commissions on any of these trades here. And remember, I've got 4 different contracts on this, so commissions are a thing to do, to consider on this. But we've effectively, for the most part, wiped out the risk on the high side. It only makes sense if you're bullish on the trade to do that, though. Seems reasonable. Now, last week, before I run out of time here, we did a couple butterfly spreads. And so one of them was Citigroup. So now this was not skewed. Okay. This one, notice it was equidistant. 97 to 93 to 101. So $4 on both sides of our middle strike. Where do we want the stock to go? We want the stock to go to 97. That's our max profitable area on this. You can see, well, we've made a whopping $6 here on this. So unrealized, of course. What's happened on Citigroup? Has it gone near 97? Or do we still think it can possibly go near 97? I'm not sure how I ended up with that on my chart. Let me try that again. Here we go. So where do we want the stock to go? We want the stock to go basically here, okay, right in there. Sorry, my line wasn't very good there. And still seems within the realm of possibility. This still seems pretty neutral. So I'm going to stick with that trade because why? We still have more than 10 days to go to expiration. We're still relatively neutral on this. And it's still positive theta, not hugely positive theta, but positive theta. And so we're going to let that sit. Okay, we'll let that cook here. We did another one, not doing so well though on this other one. Tesla. What has happened to Tesla? We're down $52 on Tesla right now. 21 days to go to expiration. 440 is our middle strike. Remember, these were not skewed. These were not broken wing butterflies we did last week. These were just even Steven, normal butterflies. We want the stock to be at 440 on this. Let's see what happened to Tesla that we're actually losing some money on this right now. 440. Well, you can see 440 is up, what, about here maybe, something like that on the graph. What's the stock done? The stock, which we kind of anticipated was going to be kind of in this range, well, it dropped out of that range. And so that's maybe a little bit of a problem. So we can look to get out, cut our losses shortly, cut our losses short and just get out right now. That's certainly one possibility. Or another way you could consider it is you could say, hey, look, the candle right now is actually it looks like maybe we're bouncing from here. This is a fairly bullish candle in the sense that we opened up lower, but now we're up 1.5% today, and we're near the high of the day. So I'm going to let this continue to go up, if it will. But if not, here's what I'm going to do. I'm going to say, if we go halfway back down this candle, okay, about 397, I'm going to look to get out of this trade and just cut our losses before they become too big. So, because it looks like it may be bouncing here. We don't have an exit trade on this right now, but I can add that in. All I need to do is highlight those three. I just kind of click and hold down the shift key and do that. I right click on this, right click. I create a closing order, and I'm going to get out of this if the stock, Tesla, marks less than or equal to 397. And that way, we're going to try to cut our losses short if it goes down. Now, caveat, there's no guarantee that Tesla is going to smoothly go down, if it reverses against us and hit 397 there. Not only do we know, not only can Tesla just gap immediately way down, that's a possibility, and that butterfly would be looking a lot worse. But even if it does go to 397, we don't know exactly what price the options are going to be there, but we can kind of estimate. But anyway, so we're down a little bit on Tesla, not too bad. Hopefully it's recovering, and we'll see on that. All right, everybody. So what did we do today? We talked about broken wing butterflies, okay? Skewing them, unbalancing them. And some of the advantages of those are you can increase the probability of success on them. You can make them more directional than the standard butterfly. But of course, you may be incurring more risk when you do so. So just make sure you look at it and you realize what you want on your trade, and then you can make your trade fit what you want. This is a condors, calendars, and butterflies class. And just on the surface, condors, calendars, and butterflies are all neutral type trades. We're not stuck to that. By doing some of these modifications on these trades, we can make them a little bit more bullish or bearish if we like. Thank you all for joining us today. Thanks, James, in the chat for helping me out on that. Make sure you subscribe to that Trader Talks channel so you don't miss future episodes there. And there's a variety of content on that channel you can double check out. Also, just remember that James teaches an Investing Master Series class on Tuesdays, 11 o'clock Eastern time. Make sure you check that out. So everybody, have a wonderful rest of the day and a weekend ahead. Talk to you later. Bye-bye.